You're listening to Capital Topics, episode number 65. This is a monthly podcast about asset management and financial and tax planning ideas for the long-term investors. Your hosts for this podcast are James Parkyn and me, François, Doyon, Rochelle, both portfolio managers at PWL Capital. In this episode, for our first topic, we will discuss what investors should be doing when markets are making new all-time highs. And next, in our second topic, we will review the UBS Global Investment Returns Yearbook 2024. Enjoy! Good morning, James. How are you today?
I'm very good, François. How are you?
I'm very good, thank you. In our first topic today, we'll try to help our listeners deal with the anxiety brought by the fact that markets are reaching new record highs. The headlines in the financial media are often alarming when this happens, suggesting that the markets have nowhere to go from here but down. Such headlines negatively impact investors' emotional behavior, and it influences their decision-making process.
Well, I agree with that, François. This type of market often triggers questions from clients. On the one hand, clients are really happy that the markets are up, but on the other hand, they wonder, well, should we be selling assets to avoid the inevitable upcoming downturn?
Right.
The market has gone too far, too fast without dropping. You hear that noise all the time. So when markets are making new highs, it's really emotionally more difficult for investors to take the plunge when there's actually new money to deploy. And so what's the right entry point, right? And there's no such thing. That's market timing. So again, these are part of the typical investor behavioral challenges when markets are setting new high, and that's when they often make mistakes that reduce their long-term returns by staying on the sidelines too long or thinking they can get out. Now remember, it's two decisions. If you get out, when are you going to get back in? And you got to find a stupid buyer when you want to get out, and you got to find a stupid seller when you want to get back in. Not a winning formula.
Yeah. So before we tell you how to deal with such events, here's a bit of context. Year to date, as of June 24th, the S&P 500 index is up roughly 14%. During that period, the S&P 500 index has reached new record highs on 32 occasions. However, before this strong sequence of record highs, you must go back 2.5 years to January 4th, 2022 for the last record high on the S&P 500 index, meaning there was a stretch of more than 2 years without the S&P index making new highs. This was the longest stretch since the 2008 financial crisis.
I mean, that's very helpful, François. Markets making new highs is a normal occurrence, except in bear markets, and then time to recovery is the issue. And we'll talk about that later in the podcast. So investors really should expect that markets will regularly make new highs. Why? Because stocks over the long run must have positive expected returns. Why would we invest otherwise? This is also true every trading day, regardless of what the markets have done yesterday, the week, or the month before. So according to research from RBC Global Asset Management, from January 1950 to March 2024, and that's like 74 years of data, the S&P 500 index has made more than 1,250 new all-time highs. This equates to an average about 17 new all-time highs every year. And it comes out to, I guess, about 6% of trading days, they say. So again, we'll add a link to our podcast page of this RBC research.
Correct, but I must add, James, that the numbers of new market highs in rising markets must be a lot higher than 17 per year, because the data surveyed also includes all the bear markets and the correction that occurred since 1950. Our listeners will understand that the markets aren't making new highs during downturns. There has been as many as 11 bear markets on the S&P 500 index since 1950, and more than double that amount in market corrections.
Yeah. So again, François, that's very well said. Logically, new market highs are reached in bull markets. Consequently, new market highs will be a lot more concentrated in those toppy bull markets. Do you have any data, François, to help investors dispel their fear of investing when the markets hit all-time highs?
Well, yes. Let's go back to the data from the RBC Global Asset Management Research. So if an investor would have invested in the S&P 500 index only at all-time highs from 1950 to 2023, their performance would still be close to the average of the index over 1, 3, and 5 years. If we look at the details, the average one-year return for investing only at all-time highs was 11.2%. And if invested on all other days, the return was 12.6%. For the 3-year period, the returns are closer with 10.9% for investing only at all-time highs compared to 11.5% on all other dates. Finally, for the 5-year period, the return difference is similar with 10.3% for investing only at all-time highs versus 11.3% on all other dates.
I bet that's going to come as a surprise to a lot of our listeners, François. So now, based on this data, can we say there's a difference in performance?
Yes, there is a difference, James, but it's relatively small. Remember, the study from RBC looked at only at investing on the days the S&P 500 index reached a new all-time high. You need to be very unlucky if you have deployed your fund only on those dates, or you must have done so on purpose. There's also a similar research from Dimensional that looks at the data, but on a monthly basis rather than daily. And they come to comparable results. Their conclusion, based on the data on the S&P 500 index from 1926 to 2023, finds, and I quote, the average return 1, 3, and 5 years after new month-end market high are similar to those after months that ended at any level. So the result for the 1-year return are even in favor of investing after months that ended at a record high. The return was 13.7% compared to 12.3% for investing after months ended at any level. For the 5-year period, the returns are almost the same at 10.2% for months ending at record highs compared to 10.3% for all other months. Again, we'll add a link to these numbers from Dimensional on the podcast page.
Again, this information I think is going to come as a surprise to many listeners as well. Again, for investors, it's counterintuitive to think I'm going to invest at market highs, especially when behaviorally they're following that tried and true old mantra: buy low, sell high. Investors need to change their mindset, particularly when they're investing in broad-based ETFs to capture capital market returns.
James, you're correct in saying that we want to buy low and sell high, but as I have demonstrated, if you are investing for the long term, it does not make much difference whether you have invested at a market high or not. However, if you are actively trading and have short-term objectives, it can make a big difference.
Well, okay, I'll agree with that, François, but investors are never comfortable investing at market highs. They believe in another mantra that markets will correct at some point, giving them a better buying opportunity. So in our jargon, we call this the market will revert to the mean. So mean reversion. What are your thoughts there, François?
Well, investor, no markets are cyclical. They will generate returns above their average long-term average returns for a period, and they will eventually pull back and generate returns below their long-term average. The problem is we don't know when those cycles will start and end. No one knows unless they have a crystal ball.
Okay, so we don't have one, François. Do you know anybody who does?
I wish.
Well, what would you say to investors who are afraid that the markets are high and that they will eventually correct, François? What's the message?
Well, first, I think investors need to realize that they are market timing and that market timing is a loser's game. Whether you're trying to time your exit point when the markets are high during a bull market or trying to time your entry point after a severe correction or a bear market, the odds of getting it right are very slim and you could miss out on some good returns. Market timing does not work in the long term, period.
So our regular listeners will know we both completely agree on that point. We have over the years been very consistent on this podcast. It's time in the market that counts, not timing the market.
Yeah. Second, investor need to realize that not all stock markets are making new highs. The focus right now is on the main U.S. indices, the S&P 500 index, the Dow and the NASDAQ, which are making new all-time highs. But other markets internationally and some indices in the U.S., such as the small cap stocks, are not making new highs.
Well, again, I think the message for our listeners here, François, is diversification is the only solution. There are other cheaper asset classes out there than U.S. large cap growth equities. The market, in quotes, is more than just the S&P 500, we both know. There are other asset classes like fixed income, bonds, REITs, real estate investment trust, Canadian equity, international equities, developed and emerging market.
Yeah, absolutely, James. And third, investors don't have to predict when the markets will stop going up and correct, but they need to be prepared for that possibility. As always, they need to keep rebalancing their portfolios. You sell what has gone up the most in this market, it's likely the US equities, to rebalance and buy other asset class in your portfolio that have not done as well.
So again, for our listeners, they'll know from, again, talking about rebalancing, as being crucial to good long-term results. When you rebalance your portfolio in a rising, market, to reflect the fact that your long-term asset allocation is essentially moved off its targets, that's a form of selling high and buying low. So by doing so in a disciplined fashion, you are effectively de-risking your portfolio by removing the overweight in this asset class.
Yes. And once your portfolio are rebalanced, if an investor is still uncomfortable with the market, the next question to ask is there too much risk in their portfolio for them? If they are nervous and stressed about the likelihood of a correction, maybe you should review your long-term asset allocation to reduce your allocation to risky assets. And the best time to reduce your allocation to equities or risky asset, and when the markets are doing well and not in the market downturn.
François, is there a different message for someone who wants to deploy fresh cash in this type of market?
Well, keeping cash on the sideline feels safe, but it's not a good investment. There's an opportunity cost for doing so. It's not because the markets are high that they can't go higher. Like we have said before, you need to look at the long term, not the short term. If you're in your 30s, 40s, or even in your 50s, if there's a market correction after you have invested your fresh cash, it will be very unpleasant indeed. But down the road, it will feel like just a speed bump. Remember that this cash will be invested for at least the next 30 years, even if you're in your 50s presently.
So the next question, François, to me is, should investors deploy their fresh cash all at once or feather it in multiple tranches?
Well, James, evidence shows that investing in one lump sum is the best option. Our research department issued a paper in 2020 titled Dollar Cost Averaging versus Lump Sum Investing. And in that paper, they demonstrate that lump sum investing beats dollar cost averaging 60% of the time, and that the average annualized overperformance is 0.38% over 10 years. For periods when the markets are expensive, they also conclude that lump sum investing still comes out ahead of dollar cost averaging.
So, maybe we should share with our listeners that in our team, we do invest in tranches, but really only for large amounts. And more often than not, when we look back, it hasn't really been that beneficial. Occasionally, there is some, major market event or geopolitical event where it does make sense. So it's really done for behavioral management, such as minimizing regret avoidance. Think you invest, the two planes hit the towers, and then we get a really nasty bear market that follows. So we want to minimize the likelihood of a negative event like that or any other unforecastable event that can materially impact those newly invested dollars. But it's really only for really material amounts in relation to the size of their portfolio. But I'll add for our listeners that we feather in these large amounts over a short period of time. We're talking weeks. We're not talking, months or years here.
Yeah, exactly. To conclude, James, market highs are normal. You should embrace them as an investor. What's important, however, is to be mindful of the risk you are taking in your portfolio because there will eventually be a correction. The timing of the next correction is impossible, but remember the markets are down on average 1 year out of 3. This means you need to be prepared. There's no way of knowing what the markets will do next. You can't control them, but you can control what you can. This means having a long-term investment strategy that reflects your risk tolerance and objectives, and having the discipline to stick to it in good and bad times. Okay, for our next topic today is a review of the 25th edition of the UBS Global Investment Returns Yearbook 2024 Summary Edition. Reviewing the yearbook is an annual ritual for our podcast. This is the first year it has been published under the UBS brand. The change came about because of the merger of Credit Suisse and UBS. We recommend our listeners to go back and listen to our podcast number 38 and number 52, in which we reviewed the 2022 and 2023 editions of the Global Investment Returns Yearbook. The content is still very relevant to what is happening currently in the financial markets. I would also like to highlight that the yearbook is produced in collaboration with Professor Paul Marsh and Mike Staunton of the London Business School and Professor Elroy Dimson of Cambridge University. They have been involved for 25 years in this project. This all being said, James, could you give our listeners an intro about the yearbook and explain its purpose?
Okay, François, I'll do that. First off, we're very happy that UBS has decided to continue to publish the annual yearbook after the merger with Credit Suisse. We talked about that last year, that we hoped that would happen. The purpose of the yearbook has not changed, and that's also good news. And I'm going to quote François from both the executive summary and chapter 1. The yearbook presents a historical record of the real returns from equities, bonds, cash, and currencies for 35 markets, spanning developed and emerging markets and stretching back to 1900. So that's 124 years of data. In chapter 1, it goes on. It is not to make forecasts, but instead to inform investors about long-run performance, to interpret it, analyze it, learn from it, and help illuminate current concerns. So I think it's fair to say, François, that the geopolitical and economic developments of recent years make the yearbook extremely relevant to helping investors make smart, money decisions, especially with their long-term money. The yearbook content always comes back to the anchor of risk and reward and the importance of diversification and asset allocation. So this, as our regular listeners know, is core to our investment philosophy.
Yeah. So, okay, James, now I'm going to start off today's review by asking you the same two questions as in prior years. First, why do you as portfolio manager find a yearbook useful?
Okay, so I'll tackle that question. And again, my answer is going to be the same as in prior years. Our discipline is to invest with an investor mindset focused on the long term. We don't want to be led astray by short-term noise in the financial media and recent financial market volatility. This challenge is daunting and applies to all investors, including us professionals. We have said it often on our podcast. It is simple to say, but not easy to do. We must always be cognizant that we can fall into a trap of trying to forecast the future. This is why the yearbook is so useful, again, François, for us portfolio managers, as you well know. The yearbook helps put current financial market events into context by comparing them to long-term capital market history.
I agree, James. I would add that the re-emergence of inflation and the central bank monetary response, plus all the major economic and geopolitical challenges that are still with us, make a historical perspective even more relevant. The yearbook is the perfect tool for us portfolio manager to get that perspective, and this exercise helps us never forget the importance of risk management.
I agree, François. Very well said. So the 2024 yearbook does not disappoint on this front. Like the ones before it, it addresses the importance of having a long-term perspective to understand risk and return in stocks and bonds. In our podcast, number 52 last year, we stated the events of 2022 should have reminded investors to fear complacency. And as mentioned, François, earlier today in the podcast, equities are setting new all-time highs. And now we can see it already. There's a lot of complacency that investors think equities only go up.
Yeah. Now for my second question, James, what are the main themes in the 2024 yearbook summary?
So, François, the 2024 yearbook summary has 4 themes. The first theme is about the current concentration of markets, and I quote, "The concentration of the equity market, both geographically and at the individual company level, makes for an interesting backdrop against which to consider long-term trends and less popular investment themes." The yearbook puts into context the geographic market concentration in U.S. equities and concludes it is a function of underperformance in other equity markets.
Well, James, this is very timely in the sense that we discussed the concentration question concerning U.S. equities when we reviewed the Magnificent Seven on our podcast number 64. And today we just covered the U.S. markets making new all-time highs. So what's the second theme, James?
The second theme is historical drawdowns. So, when markets set their highs and then whoop, they drop. Well,
Yep.
How deep can it go? So I'm going to go into more detail about this later in our podcast when I cover the main takeaways from this year's yearbook for our listeners.
Mm-hmm. Yeah, the strong performance of equity markets in 2023 and year-to-date in 2024 after the 2022's dramatic pullback in both stocks and bonds provides reasons enough to revisit the history books about historical drawdowns, I'm sure.
The third theme, François, in the yearbook is about inflation. As our listeners know, inflation is still dominating the news. The 2024 yearbook reiterates the case made in 2022 and again in 2023, and I quote, "Equities have enjoyed excellent long-run returns. They are not and have never been the hedge against inflation that many observers have suggested. Rather, stocks should be seen as excellent inflation beaters due to the equity risk premium."
Yeah, that's a very important point, James. The 2024 yearbook also makes another important point, and I quote, "With central banks potentially poised to begin rate cutting cycles, we demonstrate that the majority of long-run asset returns are earned during easing cycles."
That's a very important point that investors should be paying attention to, François. So the fourth theme is a deep dive into corporate bonds and the credit premium. The 2024 yearbook adds a long-term perspective on this major asset class with a highlight that the outstanding value is about $44 trillion US of corporate bonds. And that's almost half the value of global equities. And it's 2/3 the value of total sovereign debt outstanding. The yearbook also highlights that in the long run, investment-grade corporate bonds have offered a significant credit risk premium over equivalent government bonds of around 1%. And for high-yield bonds, there's an additional 2% above that.
Yeah, this is very timely as the returns to a higher interest rate environment has led many investors to reconsider the merits of corporate bond allocation. So, James, for listeners, what are the key takeaways from the 2024 yearbook?
Okay, so I'm going to start, François, with expected returns. The yearbook still projects that returns on stocks and bonds will remain lower than before, but will also be about 2% higher than could have been expected 2 years ago when interest rates were highly repressed and were very, very low.
Right.
The increase in interest rates implies higher expected returns on bonds. This in turn impacts expected returns on stocks.
Yeah. This is not news for regular listeners. We know from our PWL financial planning assumptions paper discussed in podcast number 61, higher nominal and real interest rates mean higher expected returns for stocks. What's the next takeaway, James?
Well, François, the next takeaway is that about the current situation regarding inflation. And again, the yearbook has a great line about children asking during a long car journey, "Are we there yet?" And so I'm going to quote the yearbook. Investors are saying, "Are we nearly there yet? Is inflation under control? When will rate hikes be replaced by cuts and are markets returning to normal?" So the yearbook shows that "are we there yet" is the wrong question. Rather, they make the point that financial history shows that while there are long-run averages, there's no such thing as normal.
Mm-hmm. James, I believe the yearbook then covers historical market volatility. How volatile are stocks and bond returns?
The yearbook covers global equities. For simplicity today, I will focus on the US and UK market history data. Since 1900, so 124 years, in an average year, the real return on U.S. equities was 8.4%. The worst performance over a single year was in 1931, the best in 1933. In an average year in the UK, the real return was 7.1%. The worst performance was in 74 and the best in 75. For both countries, stock market returns typically averaged around 0 to 20% in real terms. They were, however, below negative 20% in 11 out of 124 years in the US and 7 out of 124 years in the UK. For many other countries, the distribution of real equity returns was wider than in the US or the UK. Simply said, equity returns have been volatile throughout history.
Okay, now, James, what does the yearbook tell us about downside risk during really bad times?
So the 6 worst periods for global equity investors were the 2 world wars and the 4 great bear markets. So that's the Wall Street crash and the Great Depression, the first oil shock and world recession of 73-74, the 2000 to 2002 bear market that followed the internet bubble, and the global financial crisis that was centered in 2008.
Yeah, so James, talking about the 2008 global financial crisis, how bad was it?
Oh, it was really bad, François. As we recall, on a strict calendar year basis, 2008 was the worst year on record for the world index. In its 24-year life, the 21st century is actually has the dubious honor of hosting 4 bear markets, 2 of which ranked among the 4 worst in history.
Mm-hmm. What does the yearbook tell us about time to recovery?
Well, François, it can either take a very long time or it can happen very quickly. I'll start with the Wall Street crash of 1929. It took over 15 years for stocks to recover. And this was a very long time ago for investors. So we're going to contrast that with the COVID-19 bear market, which began on the 20th of February 2020. The global markets hit bottom at minus 35% 1 month later, and then fully recovered within 5 months. So we can say that the time to recovery is actually fairly unpredictable.
Yeah. Now, James, what does the yearbook say about historical bond market returns and volatility? Anything there?
Well, François, the yearbook states that bonds have been much less volatile than equities. No surprise there. They experienced some periods of very low and very high returns, but predictably, the worst periods for bond investors occurred during episodes of very high inflation or even those rare periods of hyperinflation.
Yeah, this is something we know after the bull market in bonds that lasted many years. I think our listener will remember the bond meltdown of 2022 due to the spike in inflation. What does the yearbook have to say about that?
Well, François, the statistics are startling, especially when you look at it in real terms. The yearbook says that the period from 1982 to 2014 was a golden age for bonds. The World Bond Index provided a real return of 7.4% per annum. That's after inflation. World bonds gave positive real returns in 28 of those 33 years. And during the 2 major stock bear markets of the early 21st century, the global financial crisis and the COVID-19 pandemic, bonds benefited from their perceived safe haven status and from policy interest rates being kept low to support national economies.
If I understood correctly, James, bonds produce equity-like performance, but with much lower volatility in an apparent violation of the laws of risk and return. These high real bond returns happen because of factors that are not going to continue indefinitely, I believe.
Completely agree with that, François. And I would also add to that, the yearbook states that from 2015 onward, the annualized, real return has been minus 1.7, with poor returns in 2021, followed by a really dire performance in 2022. So future real bond returns are clearly likely to be far lower than during the golden age of bonds. So this is another example, François, of the importance of looking at very long periods of history to understand markets. As we discussed last year in podcast number 52, even periods as long as 20 years are too short. In this case, the 2020 yearbook states, periods as long as 3 or 4 decades can be quite misleading if naively extrapolated, and particularly in the case of the bond market here.
I would add, James, another key takeaway about bonds in the yearbook which was made in last year's report as well. The yearbook makes it clear that stocks and bonds have a historically positive correlation, and that the last 20 years of negatively correlation before 2022 was not the norm. So, James, what's the takeaway for listeners here?
François, the yearbook asked the question, how well do bonds protect an investor's wealth? As we discussed in our podcast number 61 concerning Professor Cederberg's research, when you measure bonds based on real returns, the historical data is eye-opening. The yearbook states, historically, bond market drawdowns have been larger and or longer than for equities.
Wow, that's scary, given it's supposed to be the safe asset.
Well, exactly. So the yearbook highlights recent bond market carnage starting in 2020. Because of inflation, the drawdown began in July 2020, proving to be the second deepest drawdown on record with a real loss of 51%. At the end of 2023, the real bond returns were still 42% below their 2020 peak.
So from this real return data, bonds are not always foolproof safe assets, and their real value can be destroyed by inflation. So now, James, what does the yearbook say about investing for the long term and mean reversion?
Well, again, mean reversion is jargon for most investors and listeners. We all know that stocks are for the long term. In other words, the risk of investing in stocks decline when the horizon is long. In our jargon, we say after bad periods of large drawdowns, stocks will revert to the mean. The expectation is that mean reversion would not only reduce risk, but could provide timing signals that allows investors to boost returns. Now, the yearbook, in chapter 10 goes over this research they did in 2013 and highlights the conclusion that the popular evidence for mean reversion is actually an optical illusion that employs hindsight bias. I quote, "We found that the evidence on mean reversion is weak. Market timing strategies based on mean reversion typically gave lower, not higher returns. There is insufficient predictability to make equity investing safe over any horizon."
Okay, so finally, James, what takeaways does the yearbook have for listeners concerning global diversification?
Well, diversification is a topic we have often discussed as a key part of our investment discipline. The power of diversification across stocks, markets, and asset classes helps to reduce but not eliminate risk. Over the last 50 years, for investors in most countries, investing globally led to better risk-adjusted returns than investing only in their home markets.
Yeah, but exceptionally, James, this is not true for a U.S. investor. The yearbook highlights that from the perspective of a U.S.-based investor, the real return on World ex-U.S. equity index was 4.3% per year, which is 2.2% per year below what they would have earned investing only in the U.S. market.
Yeah, that data is accurate, François. The yearbook confirms U.S. investors would have been better off remaining in domestic stocks, but the yearbook still concludes, and I quote, "Prospectively, our advice to investors from all countries, including the U.S., is that they should invest globally. This is likely but not guaranteed to reduce risk and increase Sharpe ratios." Again, that's a bit of jargon. The Professor Cederberg's research, in podcast number 61 concluded similar stuff. So reaping the benefits of diversification is a long-term concept and can let you down in shorter periods. The historically extreme negative returns in 2022 of the classic 60-40 equity bond, is really a perfect example of that. But again, as we've discussed, even 30, 40 years can be short-term in terms of data series.
Yeah, this brings us back, James, to the importance of a long-term perspective and with an appreciation for the laws of risk and return. I recommend that our listeners always consider their long-term goals, their risk profile, and their ability to take risks and their time horizon when building their portfolios.
Well, as our listeners well know, we have experienced 4 equity bear markets since 2000, and we need to be paid for taking risks. So the risk premium for investing in stocks exists for a reason. They're risky. It's a necessary payment for the risk of volatility and drawdown.
Yeah. So I hope our listeners have found our review of the UBS 2024 Global Returns Yearbook useful and to helping them make smart decisions with their long-term money. We'll make sure to put a link to the UBS Yearbook in this podcast page. And as we said at the outset of this podcast, the value of the yearbook is that it always comes back to the perspective of risk and reward and the importance of diversification and asset allocation. This, as our listeners, is the core to our investment philosophy. So thank you, James, for sharing your thoughts and expertise today.
Well, François, I've really enjoyed our chat today, so thank you to you as well.
So that's it for episode number 65 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. And if you like our podcast, please share with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on August 1st. In the meantime, make sure to consult Capital Topics website for our latest blogs. See you soon.